right, good afternoon, everyone. My name is Matt Johnson. I'm the Vice President of Client Services at All Transtech. I'm happy to have this opportunity to introduce this afternoon's webcast on rail industry ad valorem taxes. This presentation will provide some background and insight into the requirements that the railcar mark owners have pertaining to the handling of taxes as is required annually. Real briefly, All Transtech, as we wait for a few more people to join, is one of North America's largest railcar management and consulting companies. We provide fleet management, technical service, and market insight to a variety of railcar owners and shippers, as well as repair facilities. And I'm going to leave a little bit of our disclaimer up while I run through a few housekeeping items. First of all, this presentation today is going to be done by John Hoyt, All Transtech's Manager of Tax and Audit Services. John's a leader in the railcar tax space, having worked in the rail industry for over 40 years now, and managing the tax processing for companies like TTX, and now in his second year with All Transtech. First, as usual, we're going to structure this presentation with approximately 45 minutes of content, followed by roughly 15 minutes of question and answer. If you have questions, please feel free to submit them in the question pane, which should be on the right side of your GoToWebinar window, and we will work through the questions during the Q&A period. Next, we're going to be sending out notifications, but we'd like to announce that All Transtech will be hosting another free webinar on Wednesday, October 30th from 2 to 3 p.m. Central, discussing the transition of loading authority from OT5 over to OT57, which takes place at the beginning of 2020. Included in this presentation will be what it will look like and how to be prepared for it. If, at the close of the presentation, you would like copies of the slide deck, please feel free to email us at publications@alltranstech.com, which is the email address that sent you this invitation. With that out of the way, thank you for joining us, and I'm happy to present John Hoyt.
Thank you, Matt, and good afternoon to everybody. I am happy and appreciate that you are able to attend. As Matt mentioned, I began my rail career 40 years ago with TTX Company. It was there that I began my work on taxes. My responsibilities at that time included the various tax functions such as sales and use, income, and property. When it comes to private railcar taxation, many of the valuation models and procedures currently used were advocated in the late 80s and 90s by the major car companies. During this time, I either developed, coordinated, or assisted in the industry position presentations that we have in place. Our agenda for today is going to be what is an ad valorem tax, our rail transportation ad valorem tax history, state process in determining ad valorem taxes, All Transtech ad valorem tax process, and where we're leading to go with our new services. First, ad valorem tax. It's Latin for to value or in proportion to the value. For property tax purposes, it can be either the value of real or personal property, and for the private railcar industry, it will pertain to the railcar fleet. Now, I'd like to start with the history of the railcar taxation on the rail industries. First, in the 1800s, in order to understand our taxation of railcars, we need to look at how the railroads were taxed. Prior to the first railroad, Americans generally traveled by either canal or wagon, with much of the funding from either the federal or state governments. Prior to the Civil War, railroads operated regionally with financing generated by the owners. It was after the Civil War that the railroads really began their expansion into multi-state travel. With the property becoming multi-jurisdictional, the states developed for ad valorem tax purposes the unit method of valuation. The unit value measures the taxable property as a whole without any reference to the component parts. It also incorporates the three approaches to value: cost, income, and market. This means that the value is based on the entire operations And with the increase in freight and passenger services, the states considered the railroads at that time a cash cow. During the 1900s up through World War II, the railroads still experienced strong growth, and the states continued to perceive the railroads as a major monetary source. Post-World War II to the 1980s, this is where we saw significant changes. Following the war, the rail industry started experiencing economic decline. On the freight side, the trucking industry expanded with the completion of the nationwide interstate system, and passengers began to travel by air since it was faster than rail. Since railroads require a large amount of fixed asset investment, the states were primarily giving the cost approach a greater weighting in value for ad valorem taxes. Since the states were not considering the railroad's economic downturn, many of the railroads began filing bankruptcy. As part of the, just as an example, the filing of the bankruptcy, the two major railroads at that time would have been the New York Central and the Pennsylvania Central. Post-1980 actually began in 1976. President Ford signed the 4R Act, which is the acronym of Railroad Revitalization Regulatory Reform. One of the issues with the recent railroad bankruptcies being excessive, due to being excessive in ad valorem taxations, the 4R Act was intended to assist the railroad industry as follows. There cannot be any discrimination between commercial and industrial taxpayers, and the rail industry in valuation, the unit approach, may include an intangible value with commercial and industrial property is just the fixed asset. Assessment ratios, there cannot be any difference in assessment ratios and we find that primarily like in the Southeast. Many of the utilities are valued at 40%, while commercial industrial is at 30% or 20%. So now railroads must be assessed at that same ratio. That includes the rail industry. Then we also have the tax rate has to be similar. So we have seen, like with Kentucky and Montana, they determine an effective rate because Kentucky, for example, in order to enhance companies to come to their state, like manufacturers, for example, they are only taxed at the state rate, but there is no county rate or city rate involved. So the states then have to take what they collect from commercial and industrial property by the value that was determined, and then that becomes the new effective rate. The law also allowed the rail industry to litigate straight into federal court and not have to go to state court. The good thing about that was in filing with the federal court, many of the federal judges are not tied to their state, needing to worry about re-election or anything like that. So it's been very beneficial for the rail industry that they've been able to go to federal court. And just as an example, the airline industry has something very similar to the 4R Act. The difference is that they cannot they cannot file in federal court. They have to go to state court. And the last, which has been a help to the private rail car industry, is that the state government or any of the local governments, they cannot assess a tax to the rail industry that is not applied to commercial and industrial. So, for example, many of the states where they when they ended up exempting a lot of the property, they had to give that same exemption to the rail industry. Excuse me. As I previously mentioned, ad valorem tax on private rail cars is going to be very similar to personal property. When the law was signed into effect in 1976, they had until 1980 to get the to get their house cleaned up so that they could transition into similar taxation uniformity with the rail industry and commercial industrial. As part of the process for the private car industry, many of the lawsuits that the industry itself had filed in that time was due to the exempt personal property or the difference in tables that were being used on commercial industrial side. As a result of this, many of the private railcar companies began quantifying discriminatory issues with the states. So the four questions that we always have is who assesses a tax on rail cars, what is valued of the rail cars, when are rail cars valued, and how are rail cars valued. So who does the assessment on rail cars? Private rail car taxation can be determined at either the state or local level. There are currently 28 states that have an ad valorem tax on the rail car industry. Of the 28 states, 26 determine a value at the state level. Texas does not have a state filing requirement for the industry. As a result, the taxpayers are required to file their rail car information to the counties. Anchorage, Alaska is the only city that might value private rail cars. If you have no mileage generated on the Alaska Railroad, there will not be any filing requirement since that is the only railroad that would bring property into the city of Anchorage. Lastly, there are 2 Native American reservations that assess a value on rail cars also. So what is valued on the rail car? The starting point for the rail car value is its acquisition cost and capitalized betterments and improvements. Betterments and improvements should be analyzed to determine if they are extending the rail car's life or just maintenance. For example, if we look at you get a grease and oil on your car, the question is, are you extending the life of that car? And I should add, let's say you capitalize it. So if you capitalize that grease and oil, have you extended the life of the car, or is it just regular maintenance? Regular maintenance, because so therefore it should not be reported even though you have capitalized it. It's not an extension of the value of car. Alternatively, if you rebuild the engine or life of the car and you've capitalized it, you've now extended the life of that car because you're getting to a point it was no longer operational, but now you needed that engine rebuild. Now you've got a working, a car that has been extended. When do they value the rail cars? The lien dates for the states is primarily January 1st of the following year. So, for example, this past year, we filed the returns that we filed in 2019 had a lien date of January 1st, 2019. The only exception will be Alabama, who would be looking back at the October 1st, 2018 lien date. And our last question, how are the rail cars valued? There are primarily 2 parts that go into the state valuation of the private rail car fleet. The first part requires the taxing body to determine the fleet value. This process begins with taxpayer self-reporting of the entire fleet cost by acquisition year. In many filings, the states provide a percent good table by year. The percent good for the corresponding acquisition years multiplied by the cost and the summation of the year's products will equate to the fleet's full market value. Please note that some states will have a predetermined value per car. The second part of the state valuation is the allocation to the state. What is important that the formula represents the physical presence within the state. As I mentioned, we have the 28 states that determine the private rail car ad valorem tax by either total fleet or predetermined value car. There are 5 states which use the gross receipts in lieu of a property tax, and then the gross receipts tax is based on the rental receipts paid by the railroads to the private rail car company for use for using the private rail car. Now, many in the industry probably do not have a gross receipts tax. It does require a filing, but you are not receiving, most cases, you're not receiving any revenue from the railroad for use of your cars. And as I mentioned, there are currently 2 Native American reservations that value private rail cars. Since the reservations are considered sovereign nations, they don't have to comply with the appraisal district practices. The private rail car industry has been fortunate so far that they have recognized the appraisal practices which the industry has advocated. For example, when the industry first heard about some of the first reservation coming on board, many people that dealt with the reservation, there was some concern and discussion, just as a side note, that if they decided that everybody within the reservation boundaries should own a Mercedes-Benz and that the reservation would provide it, that was a big concern. But as I said, I think that was more lore than actuality. And just to reiterate, when it comes to reporting to the jurisdictions, we are responsible, we the taxpayer, responsible for reporting our owned and/or operated equipment bearing our car mark as of January 1st from the prior year. Our next slide shows how the different states. So in blue, the blue states are ad valorem taxes based on the fleet value. The gross receipt states are in lieu of ad valorem taxes, and will do, as I said, they do gross receipts. And then the yellow are exempt from ad valorem taxes completely. And the states that are exempt are primarily because they do not assess a property on personal property. Excuse me, apology. So the state process in determining ad valorem taxes. As I previously mentioned, in states where the private rail car is valued, the fleet cost is reported by the acquisition year and a percent good associated with the acquisition year. The total for those years becomes the fleet value. Taxpayers may also provide additional information in order to reduce the value. Reductions in value could consist of stored or repaired equipment, adjustments for obsolescence in older equipment. Example being on the older equipment, back in the 1980s, since I was with TTX and it was the big carrier part of it was the intermodal fleet. In 1979, when I joined TTX, 89-foot flat cars was the standard intermodal carrier. Cost of the car at that time was probably around $50,000. It could carry either 2 trailers, 2 containers. 3 years later, we had the introduction of the double stack container car, revolutionized the industry. Now a car, that was primarily a 5-unit articulation. So the total, for example, of the 5-unit was probably around $150,000. That was comparable to 10 containers. So obsolescence now existed with the 89-foot car fleet because you could replace the 89-foot flat car with an articulated car, which cost, $150,000, but $25,000 per unit of the articulation. So one articulated car would basically be $25,000. So in that case, we were looking for obsolescence due to the change in the utility of the equipment. Once the total is finalized, the next step will be the allocation of the value to the state. In analyzing the allocation, it is important to determine that the model accurately reflects physical presence. There are primarily 4 allocation models currently in use. The common factor of the The common factor in 3 of the models is the state miles. Taxpayers and railroads both must provide state miles. So Model 1 is the state miles to the total system miles, which, as I mentioned, is used by most states. One of the main issues with this model is that the system includes non-movement time when rail cars are either waiting to be loaded or unloaded. So, for example, if you are basically going, well, let me backtrack. An example I like to give is a few years ago, we had a family vacation to Gettysburg, and we traveled from Chicago to Indiana to Ohio, finally to Gettysburg. And then based on a round trip, we had 84 hours of round trip travel time. Now, and we traveled, I believe it was probably around 500 miles. Now, if you looked at our travel time through Ohio, 1/3 of our time was our travel time of our miles were generated in Ohio. However, we only spent a total of 7 hours in the state. So here's a case where if you took the Ohio miles and divided it by our total trip miles, we would have had 33% of our value in Ohio would have been taxed. Our second model is an allocation based on state miles divided by a mileage allowance. The state grants a mileage allowance and recognizes that the rail cars are traveling through the state and not stopping. So, for example, we would have now looked at the fact that we only spent about 8% of our time in Ohio on that same trip compared to the total time. That was a big shift in difference. So now you're looking at, instead of, if we had a $100 value, 33% would have been 33. But now on a mileage allowance, it would have only been about 80. So or $8, excuse me. So you can see how we want to take a look at how you're physically present in the state and take the best position that would reduce those taxes. There are also a couple of states where the taxpayer can present a speed study in the allowance if the current allowance does not reflect the actual allowance that they're given to the type of rail car. The third model is what we call a car day count. There's only one state that currently uses a car day count, and that is California. So basically, California receives information from the railroads that this car entered California on the state and it exited on the state, and then they take the number of days between those two entry and exit points, and then they do a total for the entire year. That total for the entire year is then divided by either 365 days or 366, depending upon what year we're looking at. That becomes your presence in California. The last model is a special formula. And right now, Utah is probably the only one that uses this model. It's basically doing a 50% average of miles to miles and mileage allowance for travel in the state. There was also a fifth model which was discontinued in 1990. It was called the running standing car count. So basically the running standing car count was the running count of the portion was a state miles divided by a mileage allowance, and then added to that was a standing car count. So the state would select 26 days throughout the year, 2 per month, or no, excuse me, two per every other week. So they'd select 26 states. The railroads would report the cars that were in their yards on that given date at, for example, 7 a.m. They would provide all those cars, and then you would do a total of all those cars divided by the 26, and that's the average standing car count. Now, we were successful in the 90s to get that running standing car thrown out because in our analysis we found that a lot of the movements, the cars either moved into the yard before the time period, and they were really not part of a standing car count, or they moved shortly after and they were not part of the standing car count. And third, believe it or not, they got the wrong car number and mark. And then finally, as I mentioned, the gross receipts tax are in lieu of property tax, and the tax is based on revenues received by the railroads. Of the 5 states, 4 require the railroads to withhold a percentage of the revenues, while North Carolina requires you to pay the tax when you file. When we mention it in lieu of property tax, we also want to determine, it says in lieu of a property tax, what would happen if you had a property tax that would have been lower than the in lieu of property tax? So in most cases, we're probably not looking at this because you're not receiving any revenues from the railroads, but as a result of that, Wisconsin ended up reducing their rate to recognize that the property tax would have been lower for many of the taxpayers, and then Missouri completely changed it over to a valuation, to become a valuation state. Our next slide shows how the allocation models are in place. So the blue shows miles to miles, state miles to total miles. The green, those that allow a mileage allowance. California, obviously the only one in yellow because it's they're the only ones that currently use a total state car day. You got the Nebraska and Utah with their special weighted formula, and then the white, they are non-valued states. Okay, so this next slide shows our process currently in place. So we basically have it over, there are basically, four things that we have. So we've got the pre-filing in which we're gathering the data and the review. So what do we do in the data gathering process? Well, we're asking you to provide the power of attorney, your contact information, which normally contact if we just verify that nothing's changed from the year before, a fleet list, cars added and or removed, cars built, along with their cost information, and then all railroad mileage. Now, I would like to add, part of our data review, once we get this information, we begin our review first looking at cars added. For example, if you have new cars that were added from the prior year, what kind of additions were they? Were they a newly acquired car that was where you bought it new? Did you buy it used? Or is it a car that you are leasing and you have the responsibility to file because it's now your car mark? That being said, we can then move forward and say, what costs should we be reporting? So if you bought it new, obviously your build cost is what's going to be reported. If you bought it used, very important that you provide that new acquisition cost, because the states will basically start the clock all over. So if you had a car that was built for $50,000, built at a cost of $50,000, you bought it used for $20,000. We want to make sure that we're required to report that we are required to report the acquisition cost. It's definitely to your benefit that it gets reported at that lower cost. Or if it's a lease, we want to make sure that we can tell them that it's just that the cars The cars are leased. You don't own them. This is the acquisition cost of the lessor. It's not a newly acquired car. It's just, yes, you acquired a new lease, but it's not a newly acquired car. And then all railroad mileage. This is very important because not all railroads provide the mileage that we need. Even U.S. miles, they provide everything to us. We do have an issue that where there are foreign miles being generated, we don't receive that from the state. We don't know if it's there or not. And in some cases where you got total system miles, that foreign mileage becomes a benefit. Now, from our additions, from our process that we began last year with my coming on board, we currently have either generated tax savings or if we've advocated a new position, the cost benefit, the impact on your bottom line of cost has been, so it'll be an improvement to your cost efficiency. Right now, the 2-year total, we're looking at about $1.9 million for all companies that we handle. So that becomes part of our, data gathering, and that becomes then part of our data review. And then the last part of our review is we want to determine the applicable taxing bodies that are needed. So in most cases, if a return has been filed in one jurisdiction in the prior year, we want to make sure that it's being filed in the current year. So this way, we're in compliance, even though there may not be any taxation requested with it. And then when we get ready to file the returns, we want to make sure that we are making the requirements set out by the requirements that the state has. So if it's a certain way that they need it reported, we will do it. We will do it that way. So then our third step is the post-filing. So we file the returns. We now keep an eye open to see if the notice of value has been issued. If a notice of value has been issued, the first thing I want to do is I want to check to make sure that any data that we filed that we've requested reductions in value in the way we presented it, data has been adopted. If it has been adopted, then we're good. We can begin the process that notice of value is acceptable, and then we just wait for the tax bill. If it hasn't, then we need to review that assessment. Why wasn't it accepted? And then have further discussion with the taxing body to see why they didn't accept it, what additional information would be needed, and then so we can pursue it that way. Many times too, also in the post-filing, because of filing deadlines, that's when we have time to develop our allocation model. So like the states of Nebraska, where we're allowed to present additional information on the allocation of the cars, this is when we probably would be making sure that they have that copy when it's filed. Excuse me. So now that we've determined that we've received the assessments, we're content with everything that, there's no issue with anything that has been presented, now we go through the tax bill processing. So in some cases, you will be paying the taxes, but we also will distribute funds to the taxing bodies. So number one, we want to make sure all the tax bills have been received. So for example, where we have multi-jurisdictional payments within a state, I confirm that those tax bills, the value that they have apportioned to the various taxing districts equals what they said it was going to equal. Once we determine that, then I can start adding up the bills. We'll audit the tax bills, making sure that the tax rates are accurate, because we do have that for our act to fall back on. That tax rates have to be the same, and that we're not getting any additional tax that a commercial industrial taxpayer wouldn't get. And then, of course, we will pay the tax bill. So this is, right now, Altrans Tech, with my coming on board, we've been in a process of automating our system, and our intention is that during 2020, we will have our platform completed. So our system is based on the fact that we want an automated system that will, number one, be client-friendly interface. So, for example, we go through that process of requesting the power of attorney and the contact list. We would send a notification to you, okay, it's been uploaded, please verify, confirm, you have the power of attorney is signed, and then once all that is done, you would just upload it into the system again, and then we would get a notification that the work has been done. If we're looking at deadlines, then the system will also be set up that it will provide you, please, there are still some open items on your end that need to be completed. So the whole purpose is that we can cut your review and the approval time significantly in half. We want to also facilitate a system that we can upload the system, and then you can review it, make sure that what we have as an upload is correct, and then we can also follow up at that time with any questions that we may have that need to be answered. This will help facilitate a lot of that movement, so it's not playing tag either via email or phone. You're notified about it, and you're able to get that done quickly, and we can get our end done quickly. And then the other thing is it will allow us to capture the multi-year information. So, basically you're able to log on, you're able to review and do what you need to do to see where we are, to see where the process is, how the prior year compares to the current year, or going back prior even to last year. So it'll give you the capability of doing more than probably where everybody is right now. And as we said, we're looking at increasing the efficiency and getting the information that you need to do your work properly. You'll also, once we get notices of value and we finalize things, you'll get the notifications that this has been completed, so you're able to get that information online. And then reports, we're planning on creating standard reports, but we're also looking at the capability of being able to customize reports that would fit your need. And then this will also, we'll be able to do a lot of our work online. We're uploading a lot of the information that the states use, percent good tables, being able to upload them, so you'll have an idea of how everything is being put together. And then, as we said, the last thing is we're looking at, you'll be able to access any of the prior tax filings. All that information will be out there for you. So right now, there are a few companies out there that currently provide a database for property tax. Really, none of them are providing anything for the rail car industry. There have been a couple of companies that are getting into the centrally assessed end of things, but the private rail cars are a different animal than the utilities and the railroads and even the airlines. The cost information, man, that can probably be a given, but it comes down to the allocation, because what a lot of these companies are banking on is that they can extract where you have fixed sites, or where essentially assessed taxpayer has fixed sites in a jurisdiction, and be able to capture that. Because the rail cars are mobile, they're traveling, you really can't capture where they are in a particular jurisdiction, because the animal is just too big for them to try and handle. Also, if you'll notice, we've also included, these are a couple of the sheets, tabs that we are in the process of implementing right now as we move toward completion of our automated system. So I'm located in Downers Grove. Feel free to give me a call at any time. I'm more than happy to share everything. And I want to say right now, I think when it comes to the rail car industry, I'm probably the elder of the tax people in the private rail car industry. I've got a few years on my counterpart from TTX, and I think Union Tank and GATX is probably they've had, where I was the youngster, their elders have retired, and so I'm kind of the elder, and so I can more than happy to explain things to you on how the industry should be treated. So thank you, and glad to take any questions you may have.
Okay, great. So first, thank you, John. A lot of material there, definitely not a simple topic, a lot to cover, so we got a lot in. We're right on target here for timing, so we will open it up for questions. If you have a question, please go ahead and use the question pane. Again, it should be on the right-hand side of your GoToWebinar application. Again, I want to let everyone know that if you're interested in receiving the deck that was used during this presentation, you can go ahead and reach us at publications@alltranstech.com, and we will get that sent out to you. Also, John, I know there at the end you were touching on the new application, where the development team here has certainly been, as you're aware, putting in a lot of time working to get that done. We had kind of a beta run in 2019, and we had some clients able to interact with it, and we're excited about the augmentation we're doing, the efficiencies that we are going to see there. So we don't have any questions just yet. We're going to give it another minute or so, see if anything comes in. While we're waiting, just so you're aware, there is going to be an invitation. We'd appreciate it if those of you who are on would take a survey at the end. We want to make sure that we're providing material and content here that is worth your time. How are we doing? Was it a good presentation, or are there things you'd change? We're always interested in that kind of feedback, positive or negative. Negative feedback is, hopefully can be constructive and can help us improve and make it definitely add to the value it adds for you. So we did have a question come in as to whether there will be a copy of the recording of the webinar available, and it's likely there will be. We've historically posted a couple of our webinars over to our YouTube channel and linked to them from our website. We're reworking a little bit of how that's structured. YouTube has been undergoing some changes with regard to content and so forth. We don't think any of it is really going to impact our material, but we're just monitoring that. And if it does, we will be able to send out an update and let people know that it's been posted. Let's see, another quick note. I'm sorry, I mentioned the survey. That will be coming out in about an hour, so just please watch your email for that. Another question that came in: will your program upload to states that you now have to go to their website to file online?
Okay, we have probably about 5 states. Southeast seems to be doing the biggest kick of wanting to get this filing uploaded, which, fortunately, they've all kind of adapted the same process. Where currently, right now, if the ideal thing which the states have requested, which I can understand and concur with what they do. So you as the company would have an account set up with the state, and then you would give us third-party access. Now, what we do is we have the capability of importing all the information that is needed to the state, and then on it from an Excel format. So we have gotten the we've got the template from the state. We upload it, and then imported, and then basically it populates the return. There are a lot of people that might be, oh no, I've got to file with the state. It's not that bad. Actually, this is the first year that I was able to use the import function, and boy, it was nice. The other one was Michigan. They've got a little bit more to do with theirs. Theirs is basically you input the data every year, so that's a little time consuming, but it's I don't have an issue with it. It'd be great if they had the import function. And I think the state would probably greatly appreciate that they had the import function, but that's primarily it. Like I said, we've got Southeast seems to be leading the charge with a lot of the online filing, and then Utah is another state that requires the online filing also. So that's one where it can be imported. That one I take a little bit more time because I'm not their import function can be a little dicey sometimes. So that's a state I review it before I send it to make sure that the information got recorded properly.
If you don't mind, John, I'd like to touch on that answer as well, just a little bit of expounding. So right now, I believe, and correct me if I'm wrong on this, all the sites that have an online function, they are not currently configured. The states don't have them configured in a way that our system can just automatically transfer data to them. Although, as states no doubt at some point will implement that, we will have that opportunity. In the meantime, what's happening is, like you said, you're able to upload to their site. So going to the site and uploading is a manual process, but the generation of the file that is uploaded is something that will be creating automatically. Yes,
we'll basically have the Excel spreadsheet, which we would then populate, and then where we would save that file. When it came time to do the save, we would hit import, go to the folder containing the files, and then click on it. It would upload everything that's needed.
Great. Another question that came in, and John, I don't know if you know this offhand, but what is the typical savings or success rate when you contest an ad valorem tax bill via a speed study?
Well, the number one thing we want to make sure when we look at the speed study, we want to make sure that there is going to be a benefit, because the speed studies take a little bit of, there might be a little bit of cost to a speed study, because basically you've got to do a sample size for, normally what we'll do is we'll do a given month, see how many records we have, take a sample size of that, and then get those records downloaded so it will reflect. It'll calculate the time it would either, in most cases, the first point outside the state when it would enter the state, and then the first point when it exits the state, and then do the calculation. Now, where it becomes a benefit for many companies is if they've got a high presence in that state of traveling through the state. So, let's say, for example, you only travel like 10,000 miles in the state, but you know that the mileage allowance should be greater. It's probably not worth it to file a speed study. However, if you've got, if you're generating millions of miles in a given state, and the benefit is that your system miles doesn't reflect what a benefit to you, and then the speed study shows that it should, well, then we want to, I've seen, and in some of this, I'm going to be going back to my TTX days, because TTX had a big physical presence where many of the states were bridge states. We had some where I believe we probably did have about a six-figure savings per year. But see, it all depends. You really can't look at TTX, but if there is a savings, there could be, if there is a savings, you're going to get something that would be reflective of a pretty good percentage of what your tax bill would have been.
John, let me ask a little bit for my own information on that same topic. So it sounds like speed studies are kind of similar to what we have for equalization. It's something that is you kind of monitor it and say, you know, you're able to look at it and evaluate whether or not it appears to be worth pursuing. If it's something that looks like it is worth pursuing and a speed study is filed to contest the taxes, at that point, is the success rate generally pretty high? That, you know, so it may or may not be worth doing, but if it's done, is it generally accepted?
Yes, I think the issues that came up were probably in the early 90s when we were introducing the speed studies to many of the states, but eventually, you know, they had come around. Also, as a side note, as long as we're talking about speed studies, we've also, when I was with TTX, as I mentioned, I did income tax. We also used speed studies in some states in order to enhance our apportionment factor for income tax purposes. So, for example, you know, the states call it physical presence. Now, in some cases, if you're doing a miles to miles, you actually may have a benefit of using a speed study. And you know, we had, when I was with TTX, we had states come in saying, well, you should be filing an income tax. And once we showed them via the speed study, because it's physical presence, they backed down. You know, there was no income tax being assessed. In fact, we had a couple states where we were paying a very minimal amount of income tax, and we just got the income tax thrown out that, you know, we really did not have a presence in the state.
Okay, great. Well, John, you know, that's all the questions we have coming in right now. As mentioned, if you have any questions, feel free to reach out to us. We'll just take a quick step back on the slideshow. John's contact information is there. You can reach him at hoyt@alltranstech.com. Again, if you're interested in the slide deck, shoot us an email over at publications@alltranstech.com. And I'd like to thank everyone for taking some time out of their afternoon to join us. We hope this is value added, and have a great Wednesday.
And thank you.